welcome to class. My name is Susie Rhodes and I will be your instructor. Thank you for selecting Test Teachers as your online pre-licensed training provider. We have been training individuals to pass insurance and securities pre-licensing exams for over 35 years. We look forward to assisting you in passing your exam on your first attempt. Let's get started. Section 1 is economic factors and business information. There's something that I really need you to understand about this exam. It's incredibly comprehensive. The best thing that I can liken it to would be taking an exam to get your MBA and a few years of law school, all put together into one. So what you're doing is incredibly challenging, and you need to know a little bit about everything that affects the economy, not just here in the United States, but globally as a whole. So we start off with some economic principles that if you took Econ 101 back in college, you learned these things back then. But maybe you weren't a business major, or maybe college was so long ago that, like me, I forgot everything that I learned. So we're going to start off with the 4 phases of the business cycle. So the business cycle follows these 4 phases: expansion, peak, contraction, trough. How long the economy will stay in one of these phases of the business cycle is unknown. But the fact that they follow each other is a given. So it always follows these 4 phases. So expansion. This we sometimes call recovery. So when the economy is growing, we have expansion. Peak. So you climb to the top of the mountain and you can see out forever. You're at the very, very top. Peak. Once you got to the top of the mountain, there's nowhere to go but back down. So contraction. So recession. If there's 2 consecutive quarters of decline in gross domestic product, we'll call that a recession. If it lasts for 6 consecutive quarters, we would call that a depression. So we go from the peak to the contraction, recession or depression as the case may be, and then when we're down here at the bottom again, we are in a trough. So expansion, peak, contraction, trough, and so on and so forth forever. So how do we determine where we are within these 4 phases of the business cycle? There's different economic indicators that they look at on the macroeconomic level. So one of the topics that they will ask you about on your exam is the concept of what is called gross domestic product. GDP. Being that we're here in the United States, a lot of times we'll say GDP is the value of goods and services produced here in the United States. But it really is the value of goods and services produced within a country's borders. Gross domestic product. So it could be of the United States, it could be of Japan, it could be of China, it could be of any country. Something that's important about GDP is that it's the value of goods and services produced within a country, regardless of who actually owns the company. So the test likes this concept. If there is a company here within the borders of the United States, let's say that the company is in Georgia and it's an automobile manufacturer, and the company itself is a Korean automobile company. The value of the goods and services produced in the state of Georgia are included within the United States GDP. So gross domestic product, the value of goods and services produced within a country. Within a country. So this, let's say, $10 billion produced in Georgia is here in the United States GDP. This concept of GDP versus GNP is something that they want you to know on the test. GNP is the value of goods and services produced by citizens of a country. So be very careful here on the test. This $10 billion that was produced at the automobile manufacturing facility in Georgia is a company owned by a company out of Korea. So we said that this $10 billion is included within the United States GDP. We have the largest GDP in the world. The question is this $10 billion included within the United States GNP? So this is of the citizens of the country. So the $10 billion is not included within the United States GNP. Is it included within Korea's GDP? No, because it's not produced within the borders of Korea. It's produced here in the United States. Is the $10 billion included within Korea's GNP? Yes, it is. So I would expect you to have a question, something like that. It's situational based, where you'll need to determine, is it in GDP or GNP, and how that works. We look at the GDP figure as an annual amount. Even though the numbers are released quarterly, we do look at it as an annual figure. When we're looking at it this quarter versus last quarter, if we want to really gauge the growth in the economy, we need to back out the effects of inflation. To do so would be to look at real GDP. In 1991, the United States switched from using GNP to using GDP as its primary measurement of production. So we do talk about GDP. How else do we tell what phase of the business cycle we are currently in? The Department of Economics and Statistics and the U.S. Department of Commerce are in charge of publishing economic indicators. These economic indicators can be classified into 3 different types. There are leading indicators, coincident indicators, and there are lagging indicators. There's quite a few of them. I am not saying you have to memorize every single one of them, but I do want you to know a few of each of these. Leading indicators tell us, forecast for us where the economy is going. So there's a lot of emphasis placed on leading indicators because we always want to know what's coming down the road, what's going to happen next in our economy. So leading indicators are designed to predict economic activity 3 to 12 months into the future. If you were to see a rise in any of the leading indicators, that is a good sign for the economy. It shows us where we are expected to be in 3 to 12 months. So of the 10 leading indicators, they are released monthly. I want you to know at least these 3. The average worker's hours, their work week. I don't know if you had any friends during the last Great Recession, what they're calling the Great Recession, that lost any hours. But I have some friends that had their hours cut back. So instead of being able to work 40 hours, they were only allowed to work 32 hours so that hopefully the company could survive. And then finally they got their hours back. That is a good sign for the economy. It's bullish, if you will, for the economy. It's telling us that businesses have faith. We're ready to have our employees work a full work week again. It's a leading indicator. Another one that we hear a lot about is building permits. So no matter where you are, if you were paying attention at all to what was going on, all the buildings ceased during the Great Recession. There was no new office buildings being built. There was no new houses being built. But there's these signs of hope in the economy. There's new houses coming up finally, not so much commercial building going on. I suppose it depends upon where it is that you live, but this is a leading indicator when we have building going on. It's forecasting where we're going in our economic cycle. So building permits. The other one that I do want you to know for sure is the S&P 500. So Standard & Poor's 500 index, large cap companies, is a leading indicator. So lots of emphasis put on where did the S&P 500 close at yesterday. There are others that you can review, but those would be the three that I would like you to know. Coincident indicators are ones that move at the same time as the current economic cycle that we're in. I would like you to know that industrial production is a coincident indicator. So what the level of industrial production is indicative of the current economic cycle that we're in. And the number of employees on non-agricultural payrolls. Number of employees on non-agricultural payrolls. Coincident. So leading, tell us where we're going. Coincident, tell us where we are. Lagging. Lagging indicators are ones that are going to take a while to change. So these are indicators that we might have moved into the next economic phase of the business cycle, but these don't change until after we're already in the next phase. I don't know if you can remember back, if you paid attention at all, but it seemed like the whole economy had come crashing down, but there was nothing being said about being in a recession. And you thought, but it feels like we're in a recession. Aren't we in a recession? And then all of a sudden they said we were in a recession because they were waiting for those 2 consecutive quarters of decline in gross domestic product to announce to everybody that we were in a recession. It's kind of like when we go into an expansion, certain items, certain economic indicators don't reflect that we've left the trough, if you will, and begun the expansion until after the fact. So unemployment claims. Unemployment claims are lagging, which makes sense. A company doesn't choose to lay off an employee until they're having financial difficulties, and then the employee might get some sort of a payment package, and it takes a while for them to file an unemployment claim. It takes a while for it to get into the system. But the person got laid off 3 months ago or 6 months ago or 9 months ago or a year. So lagging indicators won't reflect where we're at in the current economic cycle until after we've already entered that phase. So I would like you to know unemployment claims are lagging and the change in the CPI from the previous month. So changes in the CPI. So Consumer Price Index. The Consumer Price Index is the most used measurement of inflation. So a basket of goods in all these different cities across the United States, Consumer Price Index. So we look at that and it tells us after the fact what phase of the economic business cycle we are in. So a lagging indicator. If factory output was to decrease, what would happen to unemployment claims? They would increase, of course. Another topic that they like you to feel comfortable with on your exam as far as economics goes is what is called the balance of payments account. The balance of payments account is basically an accounting record of a country's transactions with the rest of the world. So we're going to look at the balance of payments account from the point of view of the United States, but you could be looking at the balance of payments account for Japan or for China or Germany or any country. It shows the sum of transactions, financial transactions, as well as transactions that involve goods and services between individuals, businesses, and government agencies in a country with the rest of the world. So the balance of payments account. anytime a transaction occurs, there's always a credit and a debit. So when you have a debit to the balance of payments account, that is money flowing out of a country. So it would make sense that if the balance of payments account had a credit, that would be money flowing in. So a basic accounting principle, right? A debit is money going out and a credit is money coming in. So the test wants you to have an understanding of, as a transaction occurs, what happens to the balance of payments account. So if someone here in the United States was to buy a radio that was manufactured in China, what would happen to the balance of payments account here in America? It would be what? It would be a debit. And then the dollars for the radio would go to China, and that would be a credit to the balance of payments account for China. Just like if there was a French company that had a loan from an American bank and they made an interest payment, the interest payment received by the American bank would be a credit to the balance of payments account and a debit to the French balance of payments account. So France's balance of payments account would experience a debit. Within the balance of payments account, we have three different accounts. So there is what we call the current account, the capital account, and the financial account. The one that we're most concerned with on this exam is the current account. Sometimes your test questions are more complicated than you might expect them to be, and sometimes they're more simplistic than you might expect them to be. In this area, I believe that the questions are a little bit more simplistic than the reality of how the current account works. You've probably heard the reference to balance of trade. Yes. So balance of trade is something that you get out of the current account, but there's more things that happen in the current account than just imports and exports. So within the current account, we have four separate sub-accounts. We have merchandise trade. So this is where we have our imports and our exports. And you have services. We have income receipts and unilateral transfers. But the two portions of the current account that the test definitely wants you to understand are these two, trade and services. So these two together make up a country's balance of trade. We live in a global economy. So the test wants you to have an understanding of how do imports and exports affect a country's balance of trade? How does the value of their currency affect their balance of trade? So we could be looking at this for any country, but we will look at this, or at least we'll begin looking at this from the point of view of the United States. So if we look at our imports and our exports, what do we do as a country? Do we import more or export more? We always import more, primarily because the goods that are produced in other countries are so much less expensive than the goods that we produce here domestically. Another reason why we always import more than we export has to do with the fact that we don't have that much oil. So when a country imports more than it exports, what they have is called a balance of trade deficit. So if the imports are greater than the exports, we have a balance of trade deficit. And that's the way it is. That's just the way it is here in the United States. It's been that way historically. It will always be that way forever. I can't imagine that it would ever change. Tied into this concept of having a trade deficit, which is not necessarily a bad thing, we have to understand how the value of an American dollar will affect our trade deficit. So if I was just to ask you, what do you want the dollar to be versus foreign currencies? What do you want it to be, strong or weak? What do you want? We're Americans. We want strong dollars, right? Everybody's going to say that. And that's true for lots of different reasons. But when we have a strong dollar, the test wants you to understand how that's going to affect our balance of trade deficit. So if the dollar is strong, versus foreign currency, what is that going to do to our trade deficit? Is it going to make it get larger, or is it going to make it contract? So if the dollar is strong, the value of our exports, the goods that we produce here in the United States, are going to be more expensive to the other countries that might choose to purchase them. So we will be able to export less. And when the dollar is strong, the imports that we purchase are cheaper, so we buy even more. So if we import more, even more than we export, a strong dollar increases the balance of trade deficit. Increases the balance of trade deficit. So conceptually, the test wants you to be able to walk through all of those steps within that process. And some of these concepts can be confusing. And this is going to sound a little crazy, but I suggest what you do if you ever get stuck on one of these concepts is you have a blank piece of scratch paper when you go into the test, is you sit down with it and you draw it out. The dollar being strong or the dollar being weak, imports versus exports, and you take some time to think it through. Because if you slow down enough, it all makes sense. You don't want to slow down so much that you run out of time on your test. Of course, always watch your time. The test wants you to understand if the dollar was to be weak. So the dollar is weak against a lot of foreign currencies. That's a true statement for the time. The dollar is weak. What does that do to our trade deficit? It's actually good for our trade deficit. Our trade deficit will decrease. If the dollar is weak, it means that foreign currencies are stronger than the dollar is. So that we will, as the United States, be able to export more than we were able to previously. Also, when the dollar is weak, the goods that are manufactured from another country are more expensive for us, thus the United States will import less. So we export more because the dollar is weak. We import less, it's more expensive. We're not consuming as much as far as American consumers go. And the trade deficit will decrease. It will go down. It won't go away, but a weak dollar is good for the balance of trade deficit. Means it will become less. If a country's exports were to exceed its imports, which generally doesn't happen here in the United States, we would call that a trade surplus. A trade surplus. So merchandise, trade, and services will be the two portions of the current account that I'm concerned about you understanding. Within the balance of payments, we also have the capital account. It's comprised of two sub-accounts, capital transfers and acquisition and disposal of non-produced, non-financial assets. I don't expect an emphasis on that on the test. The financial account also has two sub-accounts, U.S.-owned assets abroad and foreign-owned assets in the United States. The balance of payments account is like a balance sheet where the current account is equal to the capital account plus the financial account. It's an important concept that if the United States buys more goods and services than it sells, which we just went over as a balance of trade deficit, which really creates a current account deficit, totally normal here in the United States. But when we do that, we have to finance the difference by borrowing or by selling more capital assets than we buy. So we have to borrow. So what we see is we see an inflow of foreign capital into the financial account. a lot of foreign countries own a heck of a lot of U.S. government treasury bills. So that helps us to finance our current account deficit. Concept definitely on the test. So when we have a large trade deficit, it means that the country is borrowing from abroad. That's something to think about. So some basic economic principles that the test will want you to feel comfortable with. Now we get to move on to monetary policy. The Federal Reserve Board. So the Federal Reserve, headed by Ben Bernanke, sets what is called monetary policy. Lots of talk about when Ben Bernanke talks and what's Ben Bernanke going to do with interest rates and what is going to happen with the bond purchase program, what's going to be the effect on the economy. So monetary policy, the ability of the Federal Reserve Board to attempt, I'm not going to say they control the economy, but they really have some measures that they can take that influence where we're at as far as the current economic cycle. So be careful that you don't confuse fiscal policy, which is set by Congress, with monetary policy, which is set by the Federal Reserve. They set two key interest rates that you must know. The federal funds rate. The federal funds rate is the most sensitive indicator of interest rate direction. The federal funds rate is the rate in which a member bank, a member of the Federal Reserve, would charge another member bank for an overnight loan to meet reserve requirements. So it's really the shortest loan you could ever get. It's bank to bank. It's called the federal funds rate. It is set by the Fed. The other rate that they control is what is called the discount rate. So the discount rate is the rate that the Federal Reserve would charge a member bank for a short-term loan, typically a 30-day loan. So the Fed has these choices. Do they raise or do they lower, or do they leave these rates the same? So it depends upon where we are in the economic cycle. So we can lower them. If we lower them, or if the Fed chooses to lower them, that would be done to stimulate the economy, to get us out of a recession, to make money easier for consumers, to make loans cheaper for consumers. Who sets the prime rate? You do need to be aware of that. The prime rate is the rate that is set by the banks themselves in response to changes in the federal funds rate and the discount rate. So prime is set by the banks themselves. Prime varies by region and varies by bank, but they're very similar. Prime is set, however, by the banks themselves. You need to know what LIBOR is. LIBOR is not set by the Federal Reserve. LIBOR stands for London Interbank Offered Rates. It's a daily reference rate based on the interest rates at which banks offer to lend unsecured funds to other banks in the London wholesale money market. LIBOR is commonly used as the benchmark for mortgage rates here in the United States, which is interesting. The 6-month LIBOR is used as an index. LIBOR is more sensitive, if you will, than what we have with the Federal Reserve Board here in the United States. LIBOR is set daily, Monday through Friday, by 16 different member banks at 11 a.m. So LIBOR, definition question for sure on your test. Something else that the Federal Reserve can do besides change interest rates is set the bank's reserve requirements. So how much cash does the bank have to have on hand to settle customers' transactions in cash? So if you think about the phases of the economic business cycle and what the Fed is faced with, if we're in a period where we're in a recession, let's say, and they want to stimulate spending, what are they going to do with the interest rates? Are they going to raise or are they going to lower them? Of course, they're going to lower the interest rates. What are they going to do to the reserve requirements of the bank? Generally speaking, now this doesn't always happen, but generally speaking, what would make the most sense conceptually would be if the Fed would do what to the reserve requirements if we want to stimulate spending? Lower the reserve requirements. So if they want to rein in inflation, what are they going to do with the interest rates? They're going to raise the interest rates. One of the theories behind inflation, well, of course, inflation is the general rise in prices. So one of the theories behind inflation is that there's too many dollars chasing too few of goods, which causes the prices of those goods to go up. So if you have a question and they ask you, there's inflation in the economy and the Federal Reserve needs to set forth policies to fight inflation, this is that time, like I said, where you get your piece of paper out and you draw on your piece of paper. What do you want? Do you want dollars to go into the economy, or do you want dollars to come out of the economy? You want dollars to come out of the economy in a period of inflation. So we're going to raise the reserve requirements. We're going to raise interest rates. We're going to make money harder to get to control the rise in prices. At least that's one of the desires that the Federal Reserve Board has. So when Congress gets together and elects to keep the qualified dividend rate, or elects to make the estate exclusion exemption amount $1 million or $5 million or $10 million or whatever it happens to be the year that you're taking your test. So make sure that all of the current tax laws, they're on a PDF within the course. Make sure that you know those. Changes in tax laws. Let's say they reduce the corporate tax rate to be a flat rate for all businesses of 10%. If they were to do that, that's what we call fiscal policy. So the Federal Reserve controls money, monetary policy. Changes in tax laws are fiscal policy. Budgetary changes. So taking into account how we might rein in the federal deficit. Those are budgetary changes. Those are also examples of fiscal policy. We talked about the definition of inflation. Something else that the Federal Reserve Board can do through the Open Market Committee to control inflation or stimulate spending is they can choose to buy or sell U.S. government securities. So if we're in a recession, what's the Federal Reserve Open Market Committee going to do? If we're in a recession, what do we want to do? We want to stimulate spending, right? So the Open Market Committee is going to embark on selling U.S. government securities, or are they going to buy U.S. government securities? So you have to kind of think these through. So if we're in a period of a recession, we want to get more dollars into the economy. So if they buy U.S. government securities from the U.S. government securities dealers, the Open Market Committee puts money into the economy, which would hopefully get us out of a recession. So they would buy U.S. government securities to try to stimulate the economy. If we're in an inflationary period, the Open Market Committee is going to want to sell U.S. government securities. If they sell them, then the U.S. government broker-dealers contractually have to buy them, which pulls money out of the economy. So, like I said, draw your picture, practice with these concepts, because they're definitely on the test. It's an incredibly conceptual test. You can't just sit down and memorize what the words mean, memorize the questions in our materials. That is not what this test is about. This test is truly about understanding. I urge you to pick up whatever financial publication you want. I've been reading the Wall Street Journal since I was 18 years old. I won't tell you how long that's been. But pick it up and read it, because everything that we cover in this class gives you the tools that you need to understand what it is you're going to be doing as a professional and how the economy works as a whole. So the questions themselves, they come from all over. I can't promise you that what you practice is going to be exactly what you see on the test. But conceptually, everything that we talk about, it's how the real world works. So that's your homework, besides studying all the practice exam questions, is pick up a financial publication and read it. I know you won't, but I'm urging you to. Inertial inflation. If I was to ask you, what do you expect inflation to be? Historically, historically, at least over the past 20 some years, we had this expectation that the prices of things would always go up by about 3% a year. And what that's called is inertial inflation. And that was built right into most contracts. Inertial inflation. It's really an expected inflation rate. Deflation would be if you were to go buy food at the grocery store and it was to suddenly cost less. I would be so excited. I tell you, when a box of goldfish costs $8, my kids are going to have to stop eating them. So deflation would be if things cost less. We talked about during a period of deflation or in a recession, the Federal Reserve would buy U.S. government securities from U.S. government securities dealers in order to get more money into circulation to stimulate spending. We already know that a recession is at least 2 consecutive quarters of decline in gross domestic product. Depression is 6 consecutive quarters of decline in gross domestic product. The Federal Reserve, through their monetary policy, also sets what's called Regulation T, which is the initial margin requirement in a margin account. So at a broker-dealer, sometimes the client has a cash account where they pay for everything in cash, but they sometimes also have a margin account. In a margin account, the broker-dealer loans the customer money to buy securities. So Regulation T is actually a percentage that the customer must deposit as equity into their account. And what the percentage is set by the Federal Reserve. It's currently 50%. Which is not to say, however, that a broker-dealer cannot choose to have a higher Regulation T requirement. So we'll talk more about margin in a subsequent section. But this concept of what is Regulation T, it's how much equity the customer must deposit. How much equity the customer must deposit. So the initial equity set by the Federal Reserve, although the broker-dealer could choose to make it higher. We talked about the changing in the interest rates that can be done by the Federal Reserve to rein in inflation or to stimulate spending. What do you think the stock market likes interest rates to be, high or low? The stock market, when interest rates are lowered, tends to respond positively to the lowering of interest rates. It's a bullish signal to the stock market. So lowering interest rates is bullish. Just like if Congress was to lower tax rates for businesses, that would also be bullish, the fiscal policy of tax rates. If money is easy to get, an easy money policy or a loose money policy that's done to stimulate spending to get us out of a recession or a contraction, if you will. We talked about prime is set by the banks themselves.